Welcome to the Profitable Painter Podcast. The mission of this podcast is simple: to help you navigate the financial and tax aspects of starting, running, and scaling a professional painting business. From the brushes and ladders to the spreadsheets and balance sheets, we've got you covered. But before we dive in, a quick word of caution. While we strive to provide accurate and up-to-date financial and tax information, nothing you hear on this podcast should be considered as financial advice specifically for you or your business. We're here to share general knowledge and experiences, not to replace the tailored advice you get from a professional financial advisor or tax consultant. We strongly recommend you seeking individualized advice before making any significant financial decisions. This is Daniel, the founder of Bookkeeping for Painters.
And this is Richard, tax director with Bookkeeping for Painters.
How's it going?
It is going well. We are at the end of summer. Here Labor Day is kind of like the unofficial end of summer, and we're going into the holiday weekend recording this. I know, like where you're at, Daniel, summer never ends. But for us, we're getting our last barbecues in, the pools are all closing, and we're starting into that, downward slide might be the wrong word, but into the cooler months.
Yeah. I mean, how far north you are, I would call it a downward slide. I can't take the cold, but and so we thought a good topic for today's podcast would be talking about cash flow, because for a lot of painting businesses going into the slower months after the summer, cash flow ends up being an issue. So figured that would be a good topic for today.
Absolutely.
And, yeah. And whenever I think about cash flow, I always think about Jeff Bezos back like in the late 90s, early 2000s, when Amazon was just, you look at their profit and loss and they just like lose like $10 million like consistently every year. And it was actually like, I remember watching Jay Leno late night talk show, and Jay Leno had Jeff Bezos on. And this is back when Jeff Bezos was like nerdy. He wasn't like ripped and cool looking like he is now. He was like a nerdy looking guy. And Jay Leno was like asking him like, so you guys lose money every year? He's like, yeah, we lose money every year. But the thing with Amazon and why it was so successful is that they're really good at managing their cash flow, making sure that they're always positive cash flow going, and they would take that cash flow and reinvest it into the business. And that's why they showed a loss all the time, because they were constantly growing very quickly, as we've seen over the past 30 years. But they really focused on cash flow. And one of the big things that they did that I think we can learn a lesson from is getting that payment up front from their customers and delaying payments to vendors, which we're going to talk about more in depth here.
Yeah, I think that's a really important concept, and it tends to be a little counterintuitive that your cash flow and your profit, although there's a correlation, they're not the same thing. And so like you can be like Amazon and be losing money and still have cash flow, and you can have the opposite problem where your company is making money, you're paying taxes on your income, but you're out of cash.
Mm-hmm.
And that can be just as damaging. So it's a little weird in my brain sometimes, but we have to like decouple cash flow from profit, and we have to pay attention to both of them.
Yes. Yeah. Ideally, you're profitable and also you have plenty of cash. That's the ideal state. So don't try to pull Jeff Bezos and run negative profits, but he definitely was good at managing cash flow. And the big thing to make sure your cash flow is good, like the first thing you should make sure before we get into the cash flow management stuff, is just making sure you're charging enough money. That's usually the number one reason why folks don't have cash flow in their business, is because they're not charging enough. They're not pricing correctly. That especially for the smaller businesses, like below $500,000. So before you even get to the fancy strategies that we're going to go through, make sure you're just doing the basic thing of charging enough money for your services. We've had a few podcasts on this already, but just to give you the quick notes on it, you should mark up your labor and your materials 100%. meaning you basically charge the customer twice what it costs you to do the work, and that's going to set you up to target a 50% gross profit margin. And that's going to put you on a good path to make sure you're pricing enough. Because if you're not pricing enough, you're going to have cash flow issues. So you got to fix that first before you start getting into the stuff we're about to talk about.
Yeah, and I know pricing enough, it's a very basic thing, but at least for a lot of folks, it's simple but not always easy. It sounds like it should be easy, right? Just raise your prices. What's the problem? Mentally, it can be difficult to do that sometimes because we may have come from we may not have had a lot of money growing up, and we may have a bit of a scarcity mindset. And we might think that no one's going to be willing to pay me what I want to ask for. Or we might be afraid, like, what if our clients or our customers tell me that's too much? That would be so embarrassing for me. Or what if they don't want to pay it? These are like mental hurdles that we have to get over as business owners. And it's not simple sometimes. It can be difficult. But so it's charging enough, it's simple in concept, but it's not always easy to execute. And it might require us, so this is a little exercise that I've done myself to kind of understand my worth. I've sat down with a spreadsheet and I've written down all of the investment I have made to be the accountant that I am, or in your case, the painter that you are. How much money do you have in tools, equipment, vehicles? How many years did you work to hone your skills and become the craftsman that you are? And try to assign a dollar amount to that. And it's amazing when you get done just how much of an investment you have in building your trade. And at least for me, it kind of helped understand that, yeah, I'm worth what I need to charge. Sometimes I forget that. And it might mean working with a business coach too, to kind of help you understand the importance of charging what you're worth, and understand that you're not here to please everybody. And it's okay if a few of your potential leads tell you no. So we could do a whole podcast on that topic alone. I won't go any farther in the weeds. But I just wanted to say, like, it can be a challenge to charge what you're worth.
Yes, absolutely. It's great points. It is easier said than done, for sure. But that is the number one reason why we see folks are not hitting their profitability marks is pricing, which we'll dig into again in a separate podcast, I'm sure. But you can go check out some of our previous podcasts to dive in that further. It reminds me of a story with Warren Buffett when he purchased See's Candies. The one thing that he wanted to maintain control of was the pricing. So he would set the pricing every year for the candy. And that was the only thing that he had control over. Everything else, they ran the business, like they were running the business. But he was like, hey, I need to control this one thing. And he would set the price. He was increasing it every year, of course, sometimes as much as 17% in a single year, raising those prices. And so that's a huge lever in the business for profitability, for cash flow. So that's the first place you start to improve your cash flow. Make sure you're charging enough, and then we'll move on to the next thing here. So the next two things, you can put them in two different buckets. Basically, to improve your cash flow, you can either speed up your payments from your customers, or you can slow down the payments to your vendors. Those are the two basic ways to improve cash flow outside of the profitability pricing thing we just talked about. So speed up payments from customers or slow down payments to vendors. So to start with speeding up payments from customers, the easiest way to do this is to take a down payment or a deposit when you close work. When you book a job, get money from that new customer as a down payment. And most of the folks that we're working with are taking like a 50% deposit, 50% down, half down to get on the schedule. Now, there are a couple limitations here. If you're in California or Massachusetts, you do have some limitations, legal limitations on you. In California, it's like 10% of the total job price or $1,000, whichever one's higher. And then Massachusetts is, I believe, 33% of the total project. You can't take more than that as a down payment. So the workarounds there is you take the maximum legal amount, uh, and then you do a progress payment once you start the job. So just to take an example, in Massachusetts, let's say you take that 33% deposit, and then when you start the job, then you can take another 33%, and then you take the last 33% when you finish the job. That way, you're getting that cash flow, going. And whenever sometimes, especially for newer painting businesses or even some that are doing $1 million, they're sometimes hesitant to take a deposit, or even or they're afraid to take more of a more than 20% deposit or something like that. And just working over the last 8 years with painting businesses, every time someone's increased their deposit, I've never had anybody come back and say, okay, we had to lower it because our close rates were really impacted. I think especially for residential repaint, homeowners are expecting to pay a deposit, and I don't think for the most part, there's exceptions out there, but for the most part, they're expecting to pay that deposit.
Yeah, sounds like it's like those mental hurdles that prevent us sometimes from charging what we're worth are coming into play here, where we're afraid that if we ask for 50%, maybe they say no, or they'll balk at that. And so we kind of need to get over those mental hurdles. Uh, it's not about, trying to get as much out of the customer as possible, but we need to keep our lights on. We need to be able to buy materials and pay our guys. And if a client does, or a customer does, kind of push back on it, I think it's a very good reasoning to use with them. It's like, hey, I got a lot of expenses that I have to put out so I can get your project started. So we need that deposit so we can buy the paint and the materials and whatnot. And I think most customers will be, understanding of that.
Right. Especially if you have an employees, because you can't put your employees on credit. Like when you run payroll, you have to have cash for that. And if you're paying employees, you are likely going to have to pay them before you get the money from the customer. And so you want to have that money in the bank from the customer already.
Sure.
So that's the biggest reason. And it can also help if you're trying to grow quickly. Taking that money down will help you have money to get the next customer. So definitely look at taking a deposit. If you're taking a low deposit, definitely recommend increasing it to 50% or the highest that you can legally, especially if you're struggling with cash flow issues. Because that one thing, if you're struggling with cash flow and you're profitable, but you're just struggling with cash flow, that one change will probably just solve the problem. Another note with speeding up payments from customers would be to take progress payments for longer term projects. This is especially true for commercial work that might span weeks or maybe even months. Making sure you're getting paid on a regular time frame. So for commercial projects, you probably need to make sure your contract states something that you're going to get those payments on whether it's weekly, bi-weekly, or monthly basis. The more frequent, the better for you. Obviously, you'll have to negotiate that with your commercial customer, but you want to make sure that those progress payments are happening. The more frequent, the better. Because again, it's all a timing thing with cash flow. The more you get paid, the faster you get paid, the easier it is for you to run payroll every week or every other week. So for just to do an example, let's say the terms on the contract were bi-monthly payments, meaning 2 payments per month. But if you can negotiate to get it bi-weekly payments every other week, which is a little bit faster, that will make, even if it's only by a few days, that's still can be a significant improvement to your cash flow. So don't overlook those details there. All right. So the next piece, so that we talked about speeding up payments from customers, taking a deposit, doing progress payments, getting paid faster. That will improve your cash flow. The next piece is slowing down payments to vendors. So this is especially true with your Sherwin-Williams account, your Benjamin Moore account, wherever you're getting your materials from. Well, step one is making sure you have an actual account set up with them. Some folks make the mistake of not setting up an account with Sherwin-Williams, and it comes from a good place because I am a fan of Dave Ramsey, and he's very against debt, but he's also very focused on debt from a personal perspective and not from a business perspective. And so I don't know what he would exactly recommend to a painting business owner in this situation, but I think some folks come to approach of opening up a credit line with Sherwin-Williams, and some folks have said, well, I don't want to take on any debt. And I agree with that sentiment, but in this case, I think it is a wise business move to have that credit line available, because you're extending credit to your customer by doing a project for them before you're getting fully paid. So you're essentially financing their project. You need to open up a line of credit with Sherwin-Williams so you can put some materials down on credit and get that 30 days interest free, and then pay off the balance when that bill comes from Sherwin-Williams. And that's going to significantly, again, help your cash flow, because you can hold on to your cash for an extra 30 days so that you don't have to worry about making payroll, for example. So definitely recommend using your credit lines with Sherwin-Williams, Benjamin Moore stores, and waiting until the due date to pay it. Because again, the longer you hold your money, your cash in the bank, the better your cash flow will be.
Yeah. I would argue that, there's a difference between regressive debt and debt that earns you money. So regressive debt, high interest credit card debt because we ate at a fancy restaurant or took a vacation that we couldn't afford. Those are the types of things that Dave Ramsey and financial advisors are definitely going to, be against. Debt that makes you money, a business loan that allows you to start a business that generates cash, a mortgage on a rental property that generates monthly income, or a line of credit with your supplier so that you can get the materials you need to finish the job and produce income. If used carefully, I think that is, a good form of debt. Debt is, debt's powerful. It's like a loaded gun, right? In the right hands, it's a very useful tool, but it needs to be respected. And I think, using a credit account with your supplier is a way of respectfully and responsibly using debt.
Yes. Yep. And another cash flow trick with this is with those credit lines, like with Sherwin-Williams or Benjamin Moore, you get that 30 days interest free, where you can buy materials from the paint store, put it on credit, and then you're not getting charged interest as long as you're paying by that next due date. One thing you could do to extend your credit even further, and this is especially useful for long-term commercial projects where maybe you're working on a job for 30, 60, 90 days, and maybe the payment structure is not favorable to you, which hopefully it is, because you followed the first step we talked about, which is getting favorable payment structures to you for those long-term projects. But let's say you're already set in a contract with somebody. What you can do is, put your materials on credit at Sherwin-Williams, wait the 30 days, and then use a credit card to pay down the balance. And then that extends another 30 days, basically moving that balance to your credit card. And that gets you 60 days of interest-free debt instead of just 30. And another idea for slowing down payments to vendors would be, if you use subcontractors, to make sure you have an agreement in place that states that they don't get paid until you get paid. So that is an option to set up your subcontractor agreement so that they understand that you're not going to pay them until you get the final payment from the customer, and then you'll pay them. So that's an option that I've seen some folks do, and that really helps your cash flow, because you're basically having the subcontractor finance the project instead of you.
Yeah, that's one of the advantages of using subs because, like we mentioned, you can't get away with that with employees. The employees need to be paid every payday. You can't pay them with a credit and you can't pay them with a pizza party. But subcontractors, they're business owners, right? So they get paid more than employees do. And that's because they take on more risk and they take on more responsibility. So that's, kind of it kind of goes with the territory. If you want to be a business owner and you want to get higher prices, then you can have more expectations of these folks. And so, obviously your sub agreement needs to be fair, but having payment terms of 30 days or 60 days or whatever you need to do, that could definitely be part of the agreement.
Mm-hmm. And if you do have employees, or if you're looking to bring on employees, another way to improve cash flow is to carefully consider how often you're paying your employees through payroll. So this would be one of the last things I would look at. If you've done all the things that we've talked to at this point, where you've looked at your pricing, you're profitable, you're taking a deposit, you're doing progress payments, you have a Sherwin-Williams account set up, you're doing the stacking credit with a credit card payment, you have a favorable agreement set up with your subcontractors. Another option is to pay your employees less frequently. I think by default, a lot of people pay their employees every week, and that can be very hard on your cash flow, because the more frequent you're paying something, the harder it is on your cash flow. The ideal situation is that you're paying your employees once a year, or just as infrequently as possible if you're looking to maximize your cash flow. So, especially if you're starting out, I would try to at least do biweekly payments or pay every twice a month or something like that, where you're not paying your employees so frequently, because a weekly frequency for payroll can be very, very hard on your cash flow.
Yeah. It also cuts down your admin costs. Having to sit there and tally up the hours and run payroll every single week, there's a lot of admin burden there. And if you can cut that to every 2 weeks or once a month, it becomes a lot easier. I will say, and Daniel, you mentioned paying your employees once a year. I know it was kind of in jest. Try to pay them at least once a quarter, just from a tax standpoint. Uh, the state kind of freaks out a little bit if they don't get payroll reports at least once a quarter.
Yeah, yeah. Don't pay your folks once a year.
I know
But
you were just
definitely,
joking,
yeah,
but I should probably throw that out there.
yeah.
Because yeah, you might because I we've had people who like pay themselves. Well, I'll just pay myself once a year. Yeah,
Mm-hmm.
you can do that, but prepare for the state to kind of wig out when they see, a payroll report with only zeros on it, because
Yeah.
those do get filed every quarter. So I usually recommend at least once a quarter, and I think there might even be some state laws requiring once a quarter or more frequently.
All right, awesome. So we talked about how to improve cash flow. First thing you look at is, are you charging enough? Are you profitable? If you fix that, move to getting paid faster from your customers, taking a deposit, progress payments, and then slowing down payments to vendors. Getting a credit line set up with your paint store, using that credit and paying that bill on the due date, not before. Uh, Possibly leveraging a credit card, and looking at how you're paying your subs and your employees and the frequency that you're doing that. So those are the big levers that you can pull in your business to improve your cash flow. Love to hear your thoughts on any of those items. If you'd like to join the conversation, go to Facebook, type in Grow Your Painting Business, and join the group, and we'd love to hear from you.
Yeah, thanks for listening, everyone, and we'll see you on the next episode.